Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, covering everything from core fundamentals to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Shum, head of investor relations at Focus Capital.
I'm Chad Sheeler, founder at Focus Capital.
Big question: what is a preferred return and what isn't? I think a preferred return, just the phrase is commonly used and commonly referred to, but this concept in passive real estate investing doesn't always get fleshed out, and it also gets confused with a lot of other terms. So, core explanation, couple sentences. What is a preferred return?
Preferred return is essentially your priority on the return. This is you coming first as an investor, getting your return first before the split with the operator.
Yep, it's a preference. It's who gets paid first, and then the secondary part of that is the amount. Who gets paid first, up to what amount, and then anything beyond that amount, usually a percentage point, would fall into a profit split and structure, and we can talk more about that later in the episode. But how does a preferred return function in a capital stack?
Yeah, essentially, if you're an LP investor, limited partner investor, like a preferred return is very good for you because that means you're coming first. Instead, the opposite would be if there's a straight split of like 80-20 and no preferred return at all. That means you'd be getting 80% of the profits, while the GP gets 20% from day one. Mm-hmm. Whereas with a preferred return, that means if you have what's called an 8% preferred return, that means you have priority to get the first 8% of the returns on the investment before it's split with the additional cash flow and gains with the operator down the road.
Mm-hmm. And why is it not guaranteed?
Nothing's guaranteed in investments.
Yeah. So it's a preference. But you were saying,
priority is definitely going to put you in a better position because you
correct.
First.
Yeah, I would say that the biggest thing with this is that we'll talk about the 8%. That's what we do on our deals. The 8% preferred return is up to that point, and then everything that's after that is structured off of the profit split. Our profit split on our most recent deal is 80-20, so you will get 8%, whatever that is conflated to. After that 8%, all the performance above that is split between Focus Capital and Mr. or Mrs. Investor at an 80-20 rate. It's not guaranteed though, because, and we can talk about kind of where it comes from a yearly cycle. If we are talking about a preferred return when it comes to kind of distributions and cash flow in year one, if we are not able to distribute 8% at an 8% preferred return, if it's a cumulative, which ours are, then that means that, let's say we only distribute 5%. 3% of that will roll forward and will still need to be owed and factored into your preferred return.
Yep.
If it's a non-cumulative type of preferred return, then let's say same deal, 8% preferred return, only able to distribute 5% because of we're not keeping anything on that side. We're not profiting because
there's some produce cash flow.
Yeah, because the profit split hasn't kicked in yet because we have 8%, but that 3% doesn't roll forward. It resets year two. So. Yeah. Important things for investors to note, because you could have a high potential preferred return, but if it's a non-cumulative, it doesn't matter. It resets every single year. Why is it some more common terms that people are more familiar with and more common concepts are bonds or interest payments? Why is a preferred return not a bond or not an interest payment?
Well, it's not debt, your equity. So that'd be more of a debt scenario.
Yeah.
Fun.
Yeah, and I would say that while we here at Focus Capital are going to be opening up a debt fund and income fund, any type of investment, while you are putting money in, you are not loaning this money. An investment is not a loan, so therefore it's not debt. Yeah. Therefore, it's not a bond or an interest payment. What is the difference? We kind of referenced this a little bit earlier, but what is the difference between a preferred return and a profit split, especially when it comes to real estate investing?
Yeah, like I said, the preferred return is the amount you're prioritized to earn upfront before the split happens. A split is like, okay, let's say that all the LPs have gotten their 8% preferred return. We've caught them up by year 3, 4, whatever it is, or year 2, or hopefully year 1, right? Anything beyond that point in terms of cash flow, gain in the sale, refinance proceeds, like then that amount, that additional amount above and beyond the preferred return is then split at a certain ratio, LP GV. So for example, ours usually is either 70-30 or 80-20. That with that larger amount going to LPs, small amount to GP. So what's good there is like that incentivizes the operator to do very, very well because they know their payday comes when they can give you your preferred return and then earn a split down the road.
Yeah, I think another thing to talk about is the downside. We talk a lot about risk mitigation and downsides. What happens if a property is not cash flowing? I talked about this a little bit of like, cumulative versus non-cumulative, but let's say it didn't cash flow at all during the whole thing, but we do make a profit on the sale. The order traditionally in this industry is return of capital, then the preferred return, then the profit split.
Yeah.
And so when it comes to return of capital, we at Focus Capital have never lost investor dollars and never had a capital call, but there are very real scenarios where they lose capital and so they don't even get to the preferred return or the profit split. And because of the lost capital, when they return capital, they might only be able to return X% of it to their investors. But make sure that you know that like if a property does not cash flow the entire life of the property before the exit event, that is the order: return of capital, preferred return, and then profit split. Chad, why does preferred not mean risk-free, even though it's the first thing that gets paid out?
Yeah, there's like I said earlier, there's no elimination of risk in these deals. Preferred is just, again, this is your priority. You're getting put first, Mr. Investor, Mr. Investor, to where you get the first part of the return before we can earn ours to a split.
Yeah, and from an IR perspective, I've worked in other financial sectors as well. Is preferred return, like you said, doesn't eliminate risk, but what it does do is it aligns incentives.
Yeah.
So from an operator/IR perspective, when I'm talking to an investor about the preferred return, here's how our incentives are aligned. This is how much I'll give you and why you're preferred here, because your capital is someone, even though we invest alongside our investors, a majority of this is outside investment and you should be compensated based off of that. However, our incentive alignment comes from that profit split. So 20% of 10 is not nearly as much as 20% of 100. And so we are incentivized to outperform whatever we're projecting.
Totally agree.
But you also are incentivized for us to do that as well. There are some structures where beyond the preferred return, there is no profit split. It's not a guarantee, still a preferred return, still a projection, but beyond the 5%, 8%, whatever that return is, I keep 100% of the profits. And so I'm incentivized to make sure that I get that number that I projected for you, but I'm also incentivized to maybe underquote you in the beginning. And so this is kind of your, not guarantee, but assurance that our incentives are aligned, that we are giving you as accurate a projection as possible. We will pay out on that projection, and then all of the cream on the top, you are going to benefit 70 to 80% of that, and then we will benefit 20 to 30%.
Yeah, I think a lot of other partner investors, they see a lot of value in that to where they can capture the upside, and because they want to, right? They're in this for the long haul like we are. They get the preferred return, we get a split, and they should get the upside if we do better than we thought we would.
Yeah, one thing that I kind of want to lean into is structure versus numbers. I think that there are a lot of people that at the high level are like, hey, like I want to chase higher preferred returns. What is the risk at only focusing on that number of like, okay, well, your preferred return rate is 8%, but XYZ Capital down the road, their preferred return is 9 or 10%. Why is that not the best motivation or the only thing that you should evaluate when it comes to type of cash flow?
You're still not looking at what will it take to actually get there, and what can also how can it not be achieved? Okay, just because you have a preferred rate of 10% or 15%, if the deal only achieves a 7% return overall, like doesn't matter.
Yeah,
doesn't matter at all.
Yeah.
So again, going back to looking at the deal, the operator, the risk, that's far more important than trying to compare one preferred return rate here or there.
And then even within that, let's say that we are mirroring returns 8%, focus on, is it cumulative or non-cumulative? Because I could say all day long, we don't, but I could say all day long, yeah, it's a 10% preferred return. But if we are never going to hit that projection and it's non-cumulative, I reset every single year. So if I only get you 5% for the first 4 out of the 5 years, it doesn't matter because it doesn't carry forward. Cumulative does roll forward. So you do have a little bit more alignment incentive. You do have a little bit more, not guaranteed, but assurances that, hey, year one, cash flow is a little bit lower because it's year one. Expenses are high. CapEx is going to go down in years 2, 3, 4. We're going to roll that forward. So you might not get your 8% preferred return in year one, but that 3% that you didn't get does roll forward into year two.
Yeah, that's great.
I think understanding how pref works helps investors evaluate, like I said, structure, not just headline numbers. Is there anything else that you would like to add on this? This can be a really in-depth topic, but I think that this is the best explanation from a general perspective on how people can evaluate a deal and this aspect of a deal. Was there anything else that you wanted to add on preferred returns versus profit splits, anything like that?
No, the only thing I would say would be just to, again, clarify, reiterate, preferred return is different from the average cash-on-cash return that you plan or it's projected to receive, right? Those can be often both misunderstood and confused.
Yeah.
I'd say most investors don't fully understand preferred return what it actually is. They see a number on there and they think that's my return I'm going to get per year, and they don't know it's just your priority of that return.
Correct.
And that will differ from the actual projected cash-on-cash return, which is the actual cash flows the property's producing that it should generate. So in a lot of deals, like our last couple of deals, the planned cash-on-cash return amount was maybe 7% or 6%, whereas the preferred return 8%. So what's that tell you? Okay, well, obviously in the first couple of years, if all go as the plan says, you won't be paying out the preferred return number in cash flow. It'll be a little bit lower, but it'll carry forward and it'll accumulate, right? So that's important for people to understand as well.
We're going to talk about IRR versus cash-on-cash return, so we'll be able to dip into that just a little bit more. But yeah, I think that we've covered kind of like what the basic fundamentals of a preferred return is, why it's not a bond or interest payment, and why preferred return is not the same as profit split, but they do work hand in hand.
Yep.
Perfect.
Yeah, good one.
Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.